photo credit, Getty royalty-free. The statute gaveth and the regulations may taketh away. Internal Revenue Code Section IRC Section 199A was added to the tax law to give a 20% income tax deduction to certain qualified business income. Tax lawyers, CPAs and other advisors have been struggling with how to plan for taxpayers who may receive this deduction in 2018, in the face of significant complexity, ambiguity of the statute and proposed regulations recently issued on August 8, which are surprisingly unfriendly to taxpayers in many ways. I am working with Marty Shankman, Jonathan Blattmacher, Brandon Ketron and Scotty Schenk on a book about Section 199A that will be finalized in the next week. We were hoping for some relief or guidance for many of our chapters that point out questions and inconsistencies, but very few were forthcoming. Last Thursday, on the 13th of the month, of course, the section of Real Property Trust. Department of the Treasury Attorney Advisor Audrey Ellis and Internal Revenue Service Attorney Adrian M. Michalashek, Steve and Bob did a great job guiding the presentation and pointing out issues and planning opportunities that can be considered. My partners and I are offering a free webinar to review what was discussed, and other key issues and planning opportunities under the proposed regulations on Monday, September 17th at noon. If you would like to attend, simply email me at gasman@gasmanfed.com and we can send you the registration link. We scheduled this webinar for 30 minutes, but it will probably be over much earlier. The good news for advisors was that there seems to be very little deviation or clarifications that will cause more work and analysis for those of us who are getting our arms around these rules. The bad news that just about everything that the IRS spokespeople said confirmed the anti-taxpayer positions that the proposed regulations have taken. Have you ever said, "You can't really mean what you just said," and the person responded with, "Yes, I meant very word of it"? That is what happened in this webinar. Specific points discussed include the following. 1. A trade or business must the definition thereof under IRC Section 162, which permits a deduction for expenses incurred in a business, as opposed to a passive non-business activity. This means that thousands of landlords will not be able to take the Section 199A deduction on net rent income if they simply receive rent under triple net leases with limited obligations, or do not otherwise take steps to make them active enough to be considered to be a trade or business. The examples in the regulations where a taxpayer-owned property leased to an airport apparently permitted the deduction because the landlord somehow managed these properties, in addition to simply leasing them. 2. An irrevocable trust that is a separate taxable entity which pays out part of its income to individuals will have a cumulative income limitation amount. For example, single individuals, trusts and estates with less than $157,500 in taxable income can qualify for the Section 199A deduction on trade or business income without regard to whether the trade or business is one of the specified service trades or businesses, like health, law, accounting, consulting and others, and without regard to whether the trade or business pays wages or has qualified property that would be necessary to allow a deduction for a high earner taxpayer. Please note that when I refer to the $157,500 threshold, single taxpayers, separately taxed trusts, and estates can have a partial Section 199A deduction if they have taxable income under $207,500 based upon a pro rata phase-out rule. If a trust receives $300,000 of income and retains $150,000 of this, while distributing $150,000 to an individual who otherwise has no income, then the Section 199A income passing to that trust will be considered to be passing to a taxpayer with income exceeding the threshold, even though the trust retained less than the threshold in income, and a taxpayer beneficiary who has no other income would also not qualify for the deduction, because income of $300,000 was received through the trust. As the result of this, many irrevocable trusts now being formed will be designed to be convertible into what we call a Section 678 trust, which is considered to be owned by the beneficiary for income tax purposes as described in my article 678 Ways to Qualify for the 199A 20% deduction dated August 22, 2018, which can be viewed here. The technical term for trust income that is measured and then deducted from the income that a separately taxed trust would pay tax on is called distributable net income. In the above example, the beneficiary has $150,000 of distributable net income and the trust retains $150,000 of taxable income. Taxpayers who would have put a business or investment entity interest paying $300,000 a year into a complex trust for a child may now want to form one complex trust and one Section 678 trust, and provide each trust with business or investment interests that will yield approximately $150,000 of taxable income, and the trusts may be merged into one separately taxed trust if the proposed regulations on this are made final. Yes, the above is somewhat complicated but significant tax dollars can be saved by successful families who have this trust planning put into place. 3. For a special kind of trust called an electing small business trust (ESBT), which is able to own S corporation stock, the IRS lawyers confirmed that the S corporation income and other income received by that trust would be limited to a single $157,500 threshold if the regulations are passed as written, even though the tax law distinguishes between the S corporation income and the non-S corporation income. Many advisors felt that the proposed regulations could be read to allow for two thresholds under an ESBT, but the IRS spokespersons did not see it this way. Hopefully they will turn out to be promulgated in a fair way so that taxpayers who have S corporation stocks in trusts will not be unfairly treated. 4. It was also discussed that the IRS intends to disrespect irrevocable trusts that would be taxed as separate entities, and could otherwise deduct Section 199A income if they are under the $157,500 threshold, if formed for the purpose of avoiding income tax by use of the Section 199A deduction. One of the speakers called this evil intent, and pointed out that this might be a year-by-year test. Somehow the IRS thinks that it can override decades of case law which allows taxpayers to arrange their affairs at arm's length absent specific legislative authority to the contrary, which does not appear to me to be granted to the IRS under Section 199A or its interpretive regulation authority. Judge Learnhand's famous quotation from the early 1990s comes to mind: "Anyone may arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose that pattern which best pays the Treasury." There is not even a patriotic duty to increase one's taxes, public duty to pay more than the law demands. 5. The discussion confirmed the intention of the IRS to discriminate against taxpayers who die as partners in a partnership that owns real estate or other assets that would receive a new fair market value date of death income tax basis. If the property is owned outright by a deceased person, there is a new income tax basis which can count in the 2.5% qualified property calculation. For some reason the IRS decided that the fact that the partnership tax law that allows a new fair market value income tax basis to the inheritors of a deceased partner's interest in the underlying real estate under what we call the Section 754 rules will not apply. One of the lawyers commented that the basis increase may still benefit a partner if the subject property is withdrawn from the partnership after death occurs, and the IRS spokespeople did not comment after that statement was made. But it is safest to have any taxpayer partner with a short life expectancy receive his or her share of the partnership assets that have appreciated in value before death in order to get a step up. 6. The discussion also confirmed that landlord leasing property to a specified trade or business would also be considered to be a specified trade or business if there is more than 50% common ownership between the specified trade or business and the landlord, after taking into account the IRC Section 267(b) attribution rules, which throw a wide net. The intention to discriminate across the board and beyond what most tax authorities expected that Congress was trying to do with this law is further discussed in a Forbes article entitled, "Beautiful Losers: The Discriminatory Nature of the 199A Proposed Regulations," and can be viewed by here. The primary rules that apply with respect to real estate investors and entities under Section 199A are covered under my article entitled "Proposed Regulations Blow the Roof Off of Many Real Estate Deduction Opportunities," dated August 28 here. 7. It was discussed that movie directors and coaches would be classified in the same manner as entertainers and athletes, but otherwise the spokespeople intentionally refrained from answering anything that refers to what is or is not a specified trade or business because it is going to depend on exactly what somebody does. Bob Keebler and Steve Gorin discussed that there may be a distinction between a law firm practicing law and writing title insurance and conducting real estate closings that are normally handled by title companies, but the spokespeople had no comment on this. You can view ABA's 90-minute program and receive over 500 pages of valuable PowerPoints and Steve Gorin's amazing materials on the website of the ABA section of Real Property Trust. Hats off to Steve Gorin, Bob Keebler, Audrey Ellis and Adrian Michalishek for helping tax advisors glean as much as possible from the tea leaves that we call proposed regulations. The following charts from our upcoming book can be used by advisors to explain when the income amounts impact the Section 199A deduction, and the tax brackets that apply to complex trusts, and also to children under age 19 and full-time students under age 24 who become taxed at higher brackets under the KITI tax. Chart 12 Specified Service Trade or Business Income DEDICTIBILITY Thresholds Chart. Specified Service Trade or Business Income DEDICTIBILITY Thresholds Chart. Gassman, Crotty. Complex Trust, KITI Tax Brackets Chart. Gassman, Crotty. Thanks for sharing this journey, and for any questions or comments on these rules, it takes a very large village to understand and apply the tax savings opportunities that Congress enacted to enrich our economy and the business environment. I can be reached at gassman@gassmanpay.com and have a white paper on the IRC 199 rules that can be sent upon request. Your comments on these regulations can be directed to the following address, with a copy to your congressman, senator and favorite lobbyists. Lobbyists are included in the category of specified trade or business according to the proposed regulations, so they should be working on this issue, if they are not already. CC, PA, LPD, PR, Reg 10789-218, Room 5203, Internal Revenue Service, PO. Box 7604, Ben Franklin Station, Washington District of Columbia, 20044. A public hearing will be held in the auditorium of the Internal Revenue Service, 1111 Constitution Avenue, Northwest Washington, D.C. on October 16 at 10 o'clock a.m. There is no indication as to whether milk and cookies will be served. Milk pouring with chocolate chip cookies.